Good afternoon, everybody. Good afternoon and or good evening, depending upon where you are and where you're watching from. Thanks for coming along to the latest session. We will commence momentarily. Okay, so we're going to keep this session brief. Everything really at the moment is, as it has been for a little while now, a state of culmination as such, or a state of turning point, a crossroad, you might say. But everything really is politics, US dollar, tech, and in that order. And certainly on a short-term basis with the political side of things, the political influence has been something that benefited the MSP strategy for a long time in terms of the sort of push-pull, tug-of-war sort of relationship between the risk-on, risk-off sentiment. Risk-on won effectively. Trump is seen to be pro-business, pro-politics, although the political aspect has to be, it cannot be looked past at this point. We try not to get too much into the ins and outs of politics. Politics is just perverted philosophy, of course, but the the influence just cannot be overstated, at least on a short-term basis. Okay, so what we've been seeing over the past few weeks is just on-off tariff turmoil, pushing markets down, risk markets down, risk-on markets down, tariff relief, pulling things back. So the big where we're seeing this most pronounced in as far as we're concerned is the Australian dollar. So I'll jump across this one, jump across the Australian dollar. One moment. And so just on a short-term basis, we're just seeing this relatively volatile consolidation period against the medium to longer term trend line. From a longer term perspective, this remains constructive as I see it, or bullish. And so what we'd look to see after a little bit more consolidation here is things are going according to plan, of course, is a break to the upside. This is the Australian dollar, Canadian dollar. Canada has been in the firing line as such for Trump's pen being mightier than the sword. Very significant tariff threats being made, with Canada initially resisting, talking tough, and before effectively capitulating, resulting in Trump putting the tariffs on hold. So all of these things are really just a long, drawn out political culture war type process that's basically culminating at the moment. You may have heard the stories about Elon Musk getting his due in a sense with this department or pseudo department that he's been spearheading, and the major everybody talks about Trump throwing tantrums and so forth. His opponents certainly are throwing tantrums as well at the moment as a result of the Elon Musk's Department of Government Efficiency coming in and really just pulling the rug out from underneath them from a funding perspective, and just to uncover all kinds of corruption and mismanagement, gross mismanagement, if you're being extremely generous, outright corruption, if not theft, if not outright theft of the US taxpayer, and more if you're being a little bit more objective and realistic. So with all this drama going on, you can imagine why we try to stay out of the political side of things, because it's just a great big mess. And the concern from the markets side of things, the bear case as such, is that it's just going to continue to get worse. So Trump's opponents, Trump's side's opponents, are seeming somewhat hamstrung at the moment, but that doesn't mean that they don't have tricks up their sleeve. And in fact, if you look at the sort of sentiment or rhetoric that's being put out, it does seem like they're gearing for some sort of pushback. How meaningful and how impactful that is, and how that translates to markets, certainly remains to be seen. And although we have a largely positive picture in play here, and we would never directly go against the this kind of momentum, it does remain a question, and it does remain a huge spanner that could be thrown into the works if that does come to fruition. The more balanced and sober perspective really is that we wouldn't really look for highs to be achieved in any meaningful sense. Certainly I shouldn't say certainly, but in the shorter to medium term, the more sober and balanced perspective, as I say, would be to look for further consolidation as this political stuff works its way through. With any luck, of course, as the political side of things has been going on for a very long time. The optimistic view is that things that are happening now are a necessary but painful process that needs to take place and work its way through, so we can get on with the business of being a little bit more sensible with everything that we do as a planet and as a species. If you can imagine such a thing actually occurring. The negative perspective, of course, is that this is going to be a much more drawn out process, and a much more painful process, and a much more opposed process if certain parties and certain interests do manage to get their way, which you would imagine would be at the very least, from their perspective, a minor win at least from their perspective, would be to stall, confuse, obfuscate, delay, draw out, take it into the mud, take it into the weeds, and just keep things at the very least play defensive, and prevent the process from taking place for at least for as long as possible, while they make other plans and hope for a bit of a lifeline. Let's say. So everything is tech, everything is politics, everything is US dollar, but not in that order. It's politics top down for the time being. The positive that comes from this, from a trading perspective or an opportunity perspective, is that I stand by the position that there's going to be a lot of good opportunities from a swing trading perspective on stocks on the Australian market to a lesser degree. The Australian perspective is a little bit more conflicted due to the dual alliance that we have effectively between Western major economies and the Eastern ones, as you understand. Nonetheless, a lot of volatility on the Australian market, so much so, in fact, that you really need to come out to a monthly chart to appreciate it. And this is ANZ, as you can see here, and you can just see the kind of volatility that's been going through for a long time here. Major moves, 134%, but even on just sort of a short-term basis here, relatively short-term basis within this context that we're viewing at the moment, late 21 through to even being more conservative here, or let's say down to mid 22, we just see these 30% ranges, even on even over a space of say 3 months or so, we're seeing these big 15% moves, and so most of you are older than me, and you'll remember the days when 15% was a decent move for a 6 month period, or for even for an annual move. But that's just not the world we live in anymore. At least when it comes to Australian shares. But on a medium term basis, if you can pick these moves and find these really reasonably well defined consolidative ranges, um, you will more likely than not being able to find the type of cyclical patterns and the cyclical drives, identify some shifts in short to medium term momentum in line with the longer term momentum that provide some reasonably good trading opportunities, or potentially some very good trading opportunities, if of course you manage your risk. Of course, that goes without saying, and just manage the opportunities. Jumping across to US stocks, we'll narrow it down to the tech firms for now. Even more volatility again. And just to finish up on the points of swing trading opportunities, I'll try to find something that fits the picture so I can highlight that one for you. Nvidia, of course, is the big headliner at the moment, and that sort of is a good case in point for the sort of swing trading opportunities we can see here, even just over a month and a half trading days, 33 days, 33 trading days. You have these 34, 35%, 44, 35% moves here. Geopolitical tech is less geopolitically exposed, you would say, and like Australian banks, we're seeing them continue to maintain their somewhat safe haven status. In conjunction with the TINA effect, or there is no alternative effect, which we're largely out of for a couple of years now, but still being a factor effectively. So now we're going to go through more individual stock level trading opportunities over the coming days and or weeks. And so that is why, as you may see if you're watching this on the live page, that we've created a trading calculator, a very important tool called known as a position size calculator, because position sizing really is incredibly important. So as you'll see, if you go to any of the live session pages that include analysis of stocks, as you can see here, there's a position size calculator that you can use to calculate your trade size or trade quantity according to your risk parameters. And importantly, if you're trading US stocks, you need to factor into account that there's a 1.6 to 1 USD to AUD exchange rate, which has a big effect, of course. It has about a 1.6% or a 60% difference effect upon your risk. Not just your risk, but also your opportunity. If you come in too small, you're missing out on opportunity. If you come in too large, of course, you're increasing your risk. So it all needs to be properly defined as according to your framework. There is an explanation here, a very brief one, and there's also a link to an article here which explains it in much greater depth. And you can also access this article here from the homepage there. It's this article that you'll see here. It's also linked just below the live session that you're watching at the moment. This also is on the calculators page, which is just iu.com.au/calculators, or you can filter it to the tools here, and you'll see it here, which is actually this one, which I prepared earlier. So different calculators for different purposes and scenarios and everything else. But if you go to the position sizing calculator here, you'll see it there. And again, little explanation there. But the basic idea, ladies and gentlemen, is that you first define what is a comfortable level of risk for any particular trade opportunity, a percentage-based risk. You can use dollar risk as well if you prefer. Dollar risk keeps it a little bit simpler, but it's not dynamic, so it's not adapted to the opportunity, and it doesn't adapt as your account changes. So dollar risk is often seen as a simpler way of doing things, but it's less simple in the fact that you need to constantly readjust it according to your changing account values and other things. So percentage risk is actually the best way to do it, and more broadly speaking, it's better to think in percentages anyway for the relativity and the proportionality that I mentioned. So fairly simple. Percentage risk there. Enter your account size, enter your account currency, enter your intended risk percentage. That is the amount of your account that you're willing to risk on this particular trading position or any particular trading opportunity. If you want to put in the ticker, such as Nasdaq, Nvidia, as we did there before, it will automatically set the stock currency for you, but it's not necessary, and you can manually choose this anyway. So for example, if you were trading ASX CBA, for example, you see there that it just automatically switches over to AUD. But the main value, well, not the main value, but an added value, as I mentioned before, is the fact that it does the currency conversions for you. So if you're trading a USD stock, such as Nvidia, as we looked at, with an AUD account, it needs to factor in the exchange rate here, which it picks up automatically. And so then you just enter your entry price, say $110, your exit for a loss. So it'll automatically determine whether you're going long or short, by the way. So if you enter an exit loss price that's higher than your entry price, for example, it knows that you're going short. If your exit price is lower than your entry price, it knows that you're going long or buying, in other words. Now, it also includes commission settings, and this is important, especially if you're trading. So it works in different ways, of course, according to the broker that you're using and the country that the stock is based in. Because nowadays you can trade US shares commission free as such. So there's no fixed brokerage, or there's no per share brokerage cost. But if you're trading, on the lower end of things, you might pay 2 cents per share through, say, Interactive Brokers or some of the others, not OBKR Lite, but the other one, the main one. A lot of brokers charge 2 cents per share for US companies. Now that's not going to have much of an impact if your stock price or the stock that you're trading is $110, for example. It's a tenth of 2%, 0.2%. But if you're trading a stock, if you happen to be trading a stock that's only $1 per share, then 2 cents is actually 2% of the share price. So it can make a big difference. But for most people, of course, they're trading the bigger stocks, and most of the US, the bigger cap companies have much higher share prices. So it's there. If you want to factor it in and be that just a little bit more precise, it does in fact have a much bigger impact if you're trading. If you have, say, a $10,000 account or less, and you're trading Aussie shares, which often have your $5 or $10 fixed commission. Okay, so in that case and other cases, it's very helpful, or to be more precise with your trade, your commission settings, because it will have an effect upon your quantity. But let's say, for example, in this one, we're just trading 2 cents per share, and so just to recap, there we have a $100,000 AUD account. We want to risk 1%. The stock ticker doesn't matter. The stock currency does matter. If it's USD, if it's NVIDIA, for example, it's USD. That's just letting you know the rate that it's using, which is automatically picking up. Buying in at $110, you're going to get out one way or another, whether manually or using a stop loss. If it goes down to $100, so you're long, 2 cents per share, calculate your commission, and then it gives you the calculations there. All right, so in this case, you would just go in and buy 62 shares. Okay. And then it just gives you the basis of the calculation here, like so. Nice and easy. And as the article explains, this article linked here and other places, it really is this one, latest post. As this article explains, it really is incredibly important to at least just take it takes 30 seconds realistically, once you know what you're doing and you're just following your trading plan. It takes 30 seconds to input a quick position size calculation. It's very beneficial, not just in dollar terms, but it's also very beneficial from a psychological perspective, so that you're clear, you don't have confusion about your risk, you've defined your opportunity, you've accepted the risk relative to the value of the opportunity, the expected value of the opportunity. You enter your trade, you put in your stop loss, or at the very least your alerts, and that's it. You go off and enjoy the rest of your day. And it's about as simple as that, ladies and gentlemen. Very much in line with everything else we try to promote and actively encourage here, which is just thinking about things from a logical perspective as much as possible. It's not about having to walk around in a lab coat carrying a lanyard and spreadsheets and all the rest. You don't have to change your entire identity from right thinking type person to becoming a scientist or pseudoscientist. It's just about getting things out of your head and doing them in a logical perspective, so that it's actually makes the rest of your life easier. Okay, that's the counterintuitive side of things. As such, taking a little bit of time to do things in a logical basis actually makes the non-logical part of your life more enjoyable. Okay. So get in contact if you have any questions, ladies and gentlemen. We haven't had much time to talk about Signet, the IU Signet one there, but we've added a couple of strategies there as well. One has been performing very well in the shorter term. Needs to be discussed in more detail and reviewed in more detail, of course. But it's for people that do like to chase the short term performance. And we also have one added there which has just been a lot more steady and has a full 19 years of history behind it. For those of you that, but it hasn't been doing that well over the last few years. But it's there, I suppose, as a bit of a counter balancing of perspectives for those of you that do have the inclination to take that longer term approach. So thanks again for coming along, ladies and gentlemen. Relatively short presentation today. Please get in contact if you have any questions whatsoever. And I've stressed this over the last few sessions, but please do make sure that your email preferences are updated so that we can keep you updated with the new developments specific to your preferences and profile, etc., etc. That's it. Thanks very much for coming along once again, and bye for now.